Good morning or good evening, whenever you're looking at this video. This is Bob from County 230. And what I'm going to do now is a lecture on chapter 7 in our book. We fell a chapter behind, it looks like, because I missed that day due to my badly injured foot. So what I thought I would do is prepare this lecture now for chapter 7. And then we'll go into chapter 8 tomorrow with the rest of the class, okay? And hopefully catch up that way. And I apologize for the inconvenience here. And let me see if I can share a screen with you. And hopefully you see the screen up there. You see the screen. So let me set this up the way I like it set up, because it's all about me. Whoops, we want that. Okay, chapter 7 is about fraud and internal control of cash. So let's get started. We're going to talk a lot of ethics in this chapter, I believe. Learning objectives. 1, define fraud and the principles of internal control. Fraud and the principles of internal control. And they're saying fraud is a dishonest act by an employee that results in personal benefit to the employee at a cost to the company. You stole money. That's classic fraud, okay? Why does it occur? Well, a lot of us are under financial pressure, and we're at work and we see there's access to some money here. And we say to ourselves, well, I'm going to just take a little bit. They'll never miss it. That's rationalization. So you have some financial pressure, some rationalization, and then most strongly of this pyramid is opportunity. 99% of people don't commit fraud. They have financial pressure, and they could make an argument to themselves like that I could steal if I wanted to and get away with it. But the opportunity presents itself and they don't do it. So let's talk a little bit more. 20 years ago, over 20 years ago, there was a spate of horrible bankruptcies in this country led by Enron. Enron was a publicly traded energy trading company that turned out to be pretty much a fraud. And they were able to fool the auditors for a long time, issuing phony financial statements, and a law was passed. Paul Sarbanes and James Oxley. One guy is Paul Sarbanes, I believe, was from Minnesota, and Oxley was from Maryland. They came up with a law called the Sarbanes-Oxley Act. It now requires companies to have better systems of internal control. The corporate executives and the board members, they must ensure that these controls are adequate. And for the first time, the auditors must attest to the adequacy of the internal control. That's just part of what Sarbanes-Oxley did. What are internal controls? Those are procedures and policies set forth to safeguard the assets of a company. They're the procedures to ensure enhance accuracy and reliability of the accounting records, increase efficiency, and make sure you're doing everything legally and ethically. Internal control is used in a business to enhance the accuracy and reliability of its accounting records and to safeguard its assets, okay? Internal control. And internal control can be something as simple as you lock the money in a safe when you're not using it. Internal control components, we'll get into a little bit of minutiae here, but let's go through it. We have control environment, risk assessment, control activities, information and communication, and monitoring. So one of the first controls is establishing responsibility. Establishing control is most effective when only one person is responsible for a given task. Establishing responsibility often requires limiting access only to authorized personnel, and then identifying those personnel. You're going to hear a lot about segregation of duties. What we mean here is the person who perhaps opens the mail in the morning is not the person who takes the checks out of the envelope and fills out the deposit slip, and is also the person to enter them into your computer system, and is also the person that takes it to the bank and does the bank reconciliation. If you give too many duties around one area to one person, you are asking for trouble. Segregation of duties. The secretary, receptionist, whoever opens the mail, perhaps their job is to fill out the deposit slip. They grab all the checks, then the deposit slip should go to somebody else. And that person will make the entry into the financial statements. And then another person will take it to the bank, and another person will do the bank reconciliation. That way, if there's going to be any fraud committed, it takes 4 people to pull it off rather than just one. And believe me, you could be the most honest person in the world, but if you have access to money, opportunity, you could very easily fall on the wayside, okay? Companies use pre-numbered documents, things like that. Principles of internal control. Safes and vaults. You have time clocks for when people come in and out. You keep storage areas locked. You have pass keys. You don't have everybody running around the building. You can only get into your own office. You have alarms and television monitors, all these different theft prevention activities. Independent internal verification. You record records were periodically verified by an employee who's independent. You might have somebody from the sales department come over and make sure that the cash is being handled per the exact policy. Segregation of duties. This person here maintains the cash, the books. This person makes comparison reports, reconciles differences for the treasurer, and the cashier is the one physically holding the cash. Human resources. Well, one thing human resources can do is bond employees who handle cash, rotate the duties, require vacations. This is an interesting one. They certainly want, management certainly wants the accounting department people to take their vacations, because a lot of fraud only exists because the person is there every day to cover it up and keep it going. So if it's very suspicious if you see an accountant who's worked 3-4 years in a row without ever taking a vacation day, that could indicate a real problem. And of course, background checks are important. The principles of internal control do not include management responsibilities. Data analytics and internal controls. Different aspects of journal entries can be monitored continuously. Large dollar amounts in risky areas can be flagged and investigated quickly. Recipients of payments can be easily screened. What they're saying, you have a good system where you can wildcard and automatically sort things out to see the big numbers first and give them the priority. Limitation of internal control. Well, the cost should not exceed the benefits. I mean, if you have a petty cash box with $200 in it at the most, I mean, you're not going to take that money and put it into a gigantic safe surrounded by guard dogs. That would be ridiculous expense. And the limitation to human element, the size of the business. Controls will vary according to the risk. The higher the risk, the more controls. Identify which control activity is violated in each of these. The person with primary responsibility for reconciling the bank account is also making all the bank deposits. Segregation of duties, you got to do it. Wellstone's treasurer hadn't taken a vacation in 30 years, and he got a badge for it. He got a service award. That's a human resource control. This guy, if that treasurer, I bet that treasurer left the next day for somewhere in South America. In order to save money on order slips, you don't buy pre-numbered slips. That's not a good thing. Our second objective, apply internal control principles to cash. Cash, everybody wants to steal cash, huh? So we can't say it enough. Establish responsibility. You are in charge of making up the deposit slip. You over there in the back, you're in charge of taking the money to the bank. You're in charge of putting it into the accounting records, etc. So once you have those responsibilities, you segregate those duties. And then you have documentation procedures with pre-numbered forms and documents and source information. Cash receipt controls require employees to take vacations, conduct background checks. Supervisor count cash receipts daily. Assistant treasurer compares the receipts to the bank deposit. So you have somebody counting the cash, and then there's somebody who's taking that count and comparing it to the accounting records, and then another person's matching it up against the bank deposit. Cash receipt controls. Under over-the-counter receipts, segregation of record keeping from physical custody, an important internal control. Here we have a clerk who enters and counts the cash, sends cash and count to the cashier at the end of the day. The cashier counts the money, fills out a deposit slip. He delivers it to the bank, and then the bank is going to eventually come back to us with a bank statement. The accounting department will take care of that, and the supervisor is the one who's got everything locked up at night. Mail receipts. Well, they're talking about opening the mail by two people. I've never heard of that before, but I guess that's a good control. Each check should always be endorsed with the phrase stamped on it for deposit only, just in case you lose the check, then nobody can do anything with it but deposit it. Each mail clerk signs the list, different controls in the mailroom. Permitting only designated personnel, such as cashiers, to handle cash receipts is an example of the establishment of responsibility. Cash disbursements control. More effective when companies pay by check or electronic funds transfer, like so many people do right now. It's been a long time since I wrote a check. Everything is automatically taken out of my bank account. Cash disbursements control, you have the same thing. You break up the responsibility. This person's in charge of writing the checks. This person signs the checks, etc. Cash disbursements, physical control, independent verification, same as before. The use of pre-numbered checks in dispersing cash is an application of the principle of documentation procedures. Voucher system, I'm not going to worry about a voucher system. Now here they're giving us a little problem. L.R. Cortez is concerned about control over cash receipts in his restaurant, Big Cheese. The restaurant has 2 cash registers. At no time do more than 2 employees take customer orders and enter sales. Work shifts for the employees are 4 to 8. He has your help in installing a good system of internal control over cash receipts. And you can mold this over. Again, you'd have the segregation of duties. One employee is in charge of opening up the cash register, unlocking it. Someone else is in charge of taking the money out and counting it. Just segregate the duties, make sure it's always locked up, different things. A separate cash register drawer should be assigned to each employee with register totals set at 0. Each employee should have access only to the assigned drawer. Each customer gets a receipt, and the employee should do a cash count, and a separate employee compares that cash count with the bank. And he could put in an automated point of sale system that would enable them to compare orders entered in the register to orders processed by the kitchen. Our third learning objective, control features of a bank account. Well, we all have bank accounts. I'm sure we all have checking accounts. Using a checking account, you minimize the amount of cash on hand. It gives you records. Essentially, the bank statement is a copy of the bank's records sent to the customer and made available online to the customer. EFTs, electronic funds transfer, direct deposits, used quite commonly. Let's take a look at a bank statement, because we're going to go into a bank reconciliation later on in this presentation. Your bank statement will always have the balance at the beginning of the period, or let me say it this way, the balance at the end of last month, This bank balance is as of April 30th. So this was the balance on March 31st. These are the total deposits and credits, the increases to cash, if you will. Here are the decreases, your checks, your disbursements going out the door. And here is the ending balance, 15,907.25. The bank reconciliation will always show in chronological order every transaction. Like over here, they've got 644.95. That would be, or these are check numbers apparently. Is your checking coming out? Here are amounts being credited in. These are the pluses. And they're going to show you the balance as it changes each day. At the end of the month, we have a balance of 15,907.45. We're not going to have the same balance due to timing. And we're going to have to figure out how to reconcile our bank statement, okay? Bank statements. The control features of a bank account do not include having bank auditors verify the correctness. The control feature of a bank does not include having bank auditors verify the correctness of the bank balance per books. Yeah, they do that at year end. Reconciling the bank account. Reconcile. What we have to do is prepare a report where we start with the bank balance and then we tell the bank information that we have that they don't, specifically deposits in transit and outstanding checks. Your bank reconciliation on the bank's portion is quite easy. It's going to be the ending balance of cash plus deposits in transit, less outstanding checks. What is a deposit in transit? It's a check that was written by a customer in payment to us, and it's a check that is still on its way to the bank. In other words, you got the check on the 30th of April, and you entered it into your accounting system, so it's in your general ledger. But the bank doesn't have it yet, and that very day, the bank sent out its bank statement. So that's an example of an item in transit, deposit in transit. Outstanding checks are the same thing, except these checks, which are in transit, are checks that we wrote. These are checks we wrote. Today, the last day of the month, we wrote 25 checks, and those checks got mailed Friday afternoon. None of them are going to clear the bank and be on the bank on the bank statement, so we're going to have to account for them on the reconciliation. And bank memoranda would be for a bank error. Don't hold your breath that the bank's going to make errors. Take a careful look at this template, okay? Specifically the bank side. You have a balance for the bank plus deposit in transit minus outstanding checks. That's all you have to worry about. Don't even worry about bank errors. We're not going to throw that into the pie. Your whole reconciliation on the bank side is the bank balance plus deposits in transit minus outstanding checks. That'll get you down to what we're going to call the correct balance. Now, the bank is going to tell us things we don't know. We look at that bank statement and look what we found out. We found out, one, that they made some automatic collections for us. Some people paid directly to the bank. We had NSF checks, bounce checks. NSF stands for non-sufficient funds. That's a check that a customer wrote that we entered into the system as good money, and now the bank statement comes and tells us we don't have that money. The bank might have service charges and other payments. They might have credits to us. They might have interest income. And the company could make errors. Yes, the company makes errors, not the bank. So let's take a look here. Here is an example of some information for a bank reconciliation. Laird shows a balance of $15,907.45, and the book balance or checkbook balance is $11,709.45. Laird determines the following reconciling items. We have to look at anything, we have to find anything that we know that the bank doesn't know, and we have to find out what the bank knows and is trying to tell us with the bank statement. Let me simplify it this way. we're going to take the balance per the bank and we're going to add those deposits in transit. We have them in the general ledger, so we have to tell the bank that they have it too. These outstanding checks have not cleared the bank. They total $5,904, and we are going to subtract that from the bank balance. Other deposits, unrecorded electronic receipt from a customer on account. Okay, we found that out from the bank statement. So that is going to be on our side. Our side, we start with 11,709.45, and we're going to add the 1035 number. We're going to subtract the bounce check. We're going to subtract the credit card fees. We're going to subtract the bank service charge. And then we have one little goof here where check number 23 was written correctly by us, but the bank made the mistake in this example. So that would be a $36 difference that the bank supposedly made the error. Well, let's take a look at how we took all that information to the bank statement. We said that we're adding the direct deposits to the bank balance, subtract the outstanding checks, and then we had the book side. We had that electric transfer that came in. Then we had that error on the that check where the difference was $36. And then we had a bunch of decreases. Remember, we had the debit credit card fees. We had the NSF check. And I think we had something else, a bank service charge. We add everything down and we should come up with the same number. 12,204.85. And there it is. You have now reconciled your bank statement. It's super important. We should all do it in our own worlds, but most of us don't do it. I'm guilty of not doing it myself. But the most important, in my opinion, the most important internal control of cash is to prepare the bank reconciliation every month on a timely basis. Once you see this, you have accounted for every penny that has gone through your business, okay? And you don't have to worry about any theft or anything. Now, if we went through this exercise and the balance per the books was, say, only $2,000, that might mean we have somebody who stole money. But we're unreconciled, but the bank statement would show us what happened, that something is missing. Bank reconciliation illustrated. Well, now they're asking for the journal entries. There are no journal entries associated with the bank side. There are journal entries associated with every reconciling item on the book side. For example, we're going to debit or credit cash. Every journal entry on a bank reconciliation will debit or credit cash. That's what we're talking about. So here, we found out that somebody paid us. We're going to debit cash, credit accounts receivable probably. And NSF check, we're going to put this guy back into accounts receivable and credit cash. We're going to debit credit card fees. We're going to debit bank service charges. Once we do that, we'll be in balance with the bank. And these are our different journal entries. Accounts receivable, cash, bank charges, and there's cash. There's cash. We started off with 11,709.45, and we had a couple of deposits from our reconciliation and a couple of decreases. The reconciling item in the bank reconciliation that will result in an adjusting entry by the depositor is bank service charges. Outstanding checks, deposits in transit, we know what those are. That doesn't affect us, nor does a bank error. Another bank reconciliation that they're asking you to do, we have these different reconciling items. Look at this grid and learn from this. NSF check. I'm going to stop recording for just a second if I can and get right back. So hold on. It's not letting me do that. Okay, we'll keep going. The reporting of cash and the principles of cash management. What is cash? Cash is coins, currency. It's money orders, direct deposits, wire transfers. It's credit cards and cash, as far as I'm concerned. The balance sheet reports the amount of cash at a given time. Cash equivalents could be things like a certificate of deposit under 6 months. That could be considered cash. And they're just showing you that companies show the cash and cash equivalents first above restricted cash. Which of the following statements correctly describes the reporting of cash? Cash is number one, baby, on your chart of accounts. Reporting cash. Cash and cash are comprised of coin. Cash is comprised of coins, currency, money orders. False on NSF checks. Restricted cash is classified as either a current asset or non-current asset, depending on the circumstances. True. A company could have a negative balance in its bank account. In this case, it should offset this negative balance against cash and cash equivalent. That's a bunch of jargon. That makes no sense. Because cash and cash equivalents often include short-term investments, accounts receivable should be reported as the first. No. Operation of a merchandise company. Well, we know what merchandise companies do. They buy inventory, they sell inventory, they collect payment from customers, and they start the cycle all over again. Cash management. Increase the speed of receivables collection. Keep inventory low. You want to keep your inventory as low as possible. You don't want to have so much that it sits there idly for month after month. You want to have just enough inventory to meet your orders as they come through, but not so much that it's going to sit there idly. Cash budgeting. We'll go over this a little bit. Here's an example of a cash budget. Cash budget. And what's happened here is this company has put their budget together, and they figured out that at the end of the year, they have a balance of $38,000. They put a budget together and figured out that they're going to collect $170,000 in cash receipts. That gives them an available cash of $208,000. And then they list below that the spending that has nothing to do with accounts payable. Things like inventory, salaries, purchase of truck, oddball things. Total disbursements, $182,500. So they want to come up with an excess over disbursements. So they're good there. They have $25,000. They don't have to borrow money. You go to the next year, you bring up the 25 beginning, and you go through the same process. Only this time the excess is $12,000, and the company requires 15. So they go out and they borrow 3,000. The next period, you go through the process again. You bring up the new beginning balance for the third quarter. And here they're well over 15,000, and they even have an opportunity to pay back the loan. And it just continues like that. You're going to get a lot of these budgets if you take 240. You'll be doing this exact one in 240. Cash budget wants to maintain a minimum cash balance of 15. At the beginning of the month, the cash balance is 16.5. They have cash receipts of 210, disbursements of 220. So that cash balance is going to go down to $6,500, right? How much cash, if any, to maintain the desired balance? Minimum is $15,000, so they're going to have to borrow $8,500. Okay. Let's talk about petty cash. Petty cash, that's just a little tiny recipe box filled with coins and vouchers, filled with coins and receipts, chits, if you will. Petty cash is used to pay small, tiny, annoying things that come up that you don't want to go through the trouble of writing a check. The UPS guy shows up and says there's postage due of $2. Are you going to tell them to come back later until we run a check through the system, which we might not do until tomorrow? No, you're going to just send them over to the petty cash person. She's going to hand the guy $2. He's going to sign a receipt, and that receipt's going to go into the petty cash box so that the total receipts plus the cash in the petty cash box equal the total petty cash threshold. So we set up a petty cash box. We debit petty cash, we credit cash. Once you debit petty cash, you will never touch it again. You will never touch petty cash again. All subsequent spending will be cash. The only time you would touch petty cash if they decide they wanted a $200 petty cash maximum or a lower one. Making payments. The custodian has the authority to make the payments, and management has policies. You might say nothing under $20, nothing over $20 now. Different rules. The way you set it up, you hand the check to the custodian. You write the check payable to the custodian. It's often a secretary or a receptionist. And that person, he or she, goes to the bank and cashes the check for $100 and gets a variety of bills and coins that add up to $100. Then you come back and people come through and they're asking for reimbursements out of petty cash, and you provide those. The petty cash custodian here at the end of the month requested a check for $87. The fund has 13 in cash. 13 plus 87 is 100. So she must have done things perfectly, because now it's time to write the journal entry at the end of the month. You add all the petty cash numbers up and prepare the entry at the end of the month. So she had $44 in postage, 38 in freight, and miscellaneous was 5. That adds up to $87. She takes that $87 check to the bank, cashes it, adds it back to the $13, and we're off to the races again. A lot of times you're not going to exactly come out exactly right. Anyone who's ever run a cash register or handled cash knows that people can make errors. Very easy to do so. So assume in the previous example, the custodian only had $12. Remember, they only had 12. We only have $12 now. The prior lady had 13. We have to write that off to an account called cash over insured. People ask me if that's a revenue or an expense account. And I say, it depends if you're a cash half filled or glass half filled or glass half empty person, because you're going to run both the increases and decreases through this account. So there we go. Now the 12 in the box adds up to with the 88 to 100. And here we talk about a bit about international. I don't go into international hardly at all. There's not much that will be on the test. The only thing I would say is just glance through it, concentrate on the differences. The test questions tend to be, and the things of interest are the differences between the two, okay? Like over here, whether foreign issuers should have to comply with certain extra regulation. Not too much to do with foreign accounting principles. So anyway, that's it. I hope this proves useful. Where are we today? Today is Wednesday the 22nd. It's 1:40. I'm gonna now save this onto YouTube, so you'll find it on my YouTube channel, and then later on I'll be able to copy the link over to Cornelia, who will put it on Canvas. So be prepared for this item here, and then tomorrow we do chapter 8. Thank you for listening. See you later. Bye-bye.